Lost in a multitude of numbers, graphs, and charts? No time to understand the effect of data such as GDP, inflation, income statements, and cash flow on your investments? Unsure about what's happening to the economy? Don't know the good places to invest? Risk on with equities or risk off with fixed income? Investing nowadays can be overwhelming. There are so many terms to learn and so much data to analyze amidst a sea of investment opportunities. The Atram Global Allocation Feeder Fund is designed to do exactly that. The fund is invested in both equities and fixed, combining the best ideas across the full spectrum of asset classes. Investing in equities that offer potential outperformance while using fixed income to protect against the downside, historically delivering more of the upside of global stocks compared to the downside. Flexible and diversified, it seeks the most attractive investment opportunities that give long-term growth while managing volatility. Portfolio managers and analysts will help you navigate across the sea of numbers, graphs, and charts to find you the most attractive investment opportunities, while you can sit back and relax. All this conveniently available whether you invest in Philippine peso or US dollars. Invest in a fund that gives you competitive returns with less risk. Invest in the Atram Global Allocation Feeder Fund. For more information, visit www.atram.com.ph. Almost everyone has at least one relationship with one financial institution. Practically all businesses, regardless of industry, require financial services at some point in time, be it credit cards, bank and time deposits, loans, insurance, or investments. But financials go beyond these. It evolves through technology, and rapid innovation has given birth to a long-term trend called fintech or financial technology. Fintech is a powerful trend. Electronic payments are steadily growing with a lot of room to grow exponentially. On top of this, we also have the rise of cryptocurrency and other blockchain technologies. With the Atram Global Financials Feeder Fund, investors can participate in growth of companies around the world that are involved with providing financial services. The fund gives you access and diversification to global financial names that we normally do not have locally. The fund also invests in fintech, which a normal financials fund would not. Invest in the biggest global companies in the financial industry. Participate in the global recovery. Diversify your investment portfolio by investing in this fund. Invest in the Atram Global Financials Feeder Fund. For more information, visit www.atram.com.ph.
The world around us is ever-changing. We are facing development challenges on a global scale. Today, 41 million out of 57 million deaths are attributable to non-communicable diseases. In the Philippines, 5 out of 10 families were deprived of basic education. The Philippines also ranked 3rd in the top 10 countries with the most natural disasters. Women participation in the labor force is less than half at 48%, while male participation is at 77%. The United Nations identified and adopted 17 Sustainable Development Goals or SDGs to address the challenges faced by economies, societies, and the environment. We at Atram support the UN and the SDGs by launching the Atram Philippine Sustainable Development and Growth Fund. The fund is designed to invest in Philippine companies that score high in terms of the integration of UN SDGs into their operations and strategy. Through this fund, we hope to encourage PSC-listed companies to integrate UN SDGs into their businesses. We must work together to make a world a better place. Atram Philippine Sustainable Development and Growth Fund. Invest in a sustainable future together. Invest to thrive. Invest together. For more information, visit www.atram.com.ph.
Megatrends are shaping and influencing the global economy: urbanization, technological innovation, resource scarcity, and demographic and social change. The long-term shifts in these trends create multiple investment opportunities. They gave rise to a new type of investing called thematic investing. Enter the Atram Global Equity Opportunity Feeder Fund. The fund invests into the themes that would benefit the most today, making it the first global multi-thematic fund in the Philippine market. Unlike traditional investing, thematic investing is not constrained to sectors or locations, focusing instead on themes and megatrends. It distills the megatrends to find relevant topics that work in this current market environment. It finds the next big thing and invests in it at a very early stage. With this multi-theme fund, investors will have exposure to various companies that will drive future market growth. What's more, you can invest in all the new developments in this world in Philippine peso or US dollar, making it accessible to everyone. Invest in the fund that invests in the stories of tomorrow, today. Invest in the Atram Global Equity Opportunity Feeder Fund. For more information, visit www.atram.com.ph.
All right. So hello and good morning, everyone. Thank you for joining this week's episode of Atram Webinar Series. I am Jerome Go. I am the head of Atram Wealth, Independent Wealth Consultants channel. But for this morning, I'm going to be your host. So why do we make the financial and investment decisions that we do? Big investing errors often arise from psychological and even behavioral biases. Many are actually unaware of these implicit biases, which may manifest in ways that distort our investment decisions. In today's webinar, we'll tackle the most common biases in investing and what smart investors should be aware of to avoid falling into this emotional trap. If you have questions, you may send them as early as now by clicking on the Q&A button below your screen. So before we begin, I'd like to let you know that this session is actually recorded and that copies will be disseminated as well as posted on all our social media platforms. Also, please don't forget to visit our website, www.atram.com.ph, for a more detailed information about all of the funds that we have. If you have any friends who you think would like this webinar but are unable to attend this morning, please feel free to share the YouTube replay of this session by visiting our YouTube channel, Atram Studio. Scan the QR code to visit our official social media pages. Of course, we would like to invite you to join our Atram's official Viber community group, #AtramPH community, to stay updated on the latest announcements, advisories, and reminders. Again, scan the QR code or visit the link on your screen and get a chance to win Atram merchandise. We would like to make this webinar to be as interactive as possible. So please don't hesitate to send your questions in the Q&A tab all throughout the webinar. Each question you send is actually a raffle entry for a chance to win limited Atram merchandise. Winners will be announced at the end, so make sure you stay until the end. We will also be wrapping up with a quick feedback survey after the webinar. So we do hope you can share your thoughts with us about our session today and how we can further improve our future webinars. So without further ado, let me briefly introduce our speaker this morning. He is the Executive Director and Head of Southeast Asia Funds for JP Morgan Asset Management, Supreet Bhan. Supreet is responsible for the firm's sub-advisory business in Southeast Asia and India. He was previously head of fund sales for the firm's onshore business in India. Since relocating to Singapore, where he is today, in early 2017, Supreet led the firm's funds and institutional business in Southeast Asia until 2020. He began his career in 2002 with Kotak Life and worked with DSP BlackRock investment managers from 2004 until 2013. Supreet is a Bachelor of Technology and an MBA by qualification. Hello, Supreet. How are you?
I'm doing very well, Jerome. Thank you for having me. And thank you for the kind introduction as well.
I guess you're in the office now. Very sunny in Singapore.
Well, I must admit, this is a fake virtual background. The actual background is dark and cloudy, a lot like the markets feel so far year till date. So no, I have to apologize for the fake background because I'm doing this from home.
Yeah, that's okay. We have to work what we have, right? It's also dark here in Manila, scattered rain all over.
Yeah, like I said,
a
little bit of a representation of the global economy, how clients are feeling. It's dark, overcast, and a little bit depressing in the first 3 months of the year, right?
Yeah, but of course, every rain has to stop at some point, right? And it's going to be sunny at some point. So I guess that's another point that our audience can take for this morning. But of course, this webinar today is all about your discussion. So, Supreet, the floor is yours.
Great. Once again, Jerome, thank you so much for having me this morning, and good morning to everybody who's joined in. Truly appreciate you all making this time on a weekday. And through the course of this presentation, I will try and walk you through some of the behavioral biases that Jerome briefly alluded to. I think Jerome's done a great job of teeing us up with regards to what are some of the challenges that investors face. I actually often like to start a presentation like this by putting in front of clients that it's not information advantage that leads to success in investing. I often like to start by quoting some revered and eminent investors, none other than one of the most revered ones, which is Warren Buffett. He actually is quoted very often as saying, when others get greedy, be fearful. And when others are fearful, get greedy. Think about it. Why did he say that? To me, while Jerome did make an introduction, what my intro now does is remind me of how old I'm getting. And if you noticed, he said I started my career in 2002. I've been in the industry for 20 years. So in addition to being a keen student of the capital markets, which is stock markets, debt markets, etc., I'm also actually a very keen student of investor behavior. And what I've learned, and I continue to learn through my experience of working with clients, is not every decision is made rationally. And investment isn't all about science, which is data analysis and so on. Actually, it's a lot about art. I like to say it's almost about the heart, which is the emotions. So when we walk through some of these emotional biases, maybe some might resonate with you. Let me give you a disclaimer right at the outset. I suffer from a lot of them too. It's just that over a period of time, maybe I've experienced some of the mistakes that I've made where I've allowed these emotional biases to overpower my rational decisions. And maybe, just maybe, I'm a slightly better than most of us on this call. So I'm going to share some of those experiences as I walk through this. So Jerome did say there are a number of biases, but we're going to focus on a few of them on this call. And I echo his sentiments. The best use of your time over the next 55 minutes is if you ask questions, and I'd be very happy to see what all I can answer to the best of my abilities. So what I'm doing while I'm speaking is putting up some of these behavioral biases that we're going to speak about: anchoring, herding, overconfidence, and loss aversion. Now, normally, I would start this presentation with left to right, starting with anchoring and going up to loss aversion. But over the last 6 months, particularly in the first 3 months, the world's turned around. It's a different world, which is why I'm going to turn my presentation a little bit and start with the one on the right, which is loss aversion, which if you are invested in the market, it's quite possible you're facing this behavioral bias today. And why do I say you're facing this behavioral bias, and what really is loss aversion as a behavioral bias? Research which has been done on this, and there's plenty of research which has been done. If you do like this topic of behavioral finance, I would recommend 2 books to you to read at your leisure. One is a book called Thinking Fast and Slow by Daniel Kahneman. The other one is Nudge by Richard Thaler. Both of them received Nobel Prize for the work that they've done in behavioral economics. But again, I digress. Research actually has proven that the pain of losing money is a lot more profound than the joy of making it. What does that mean? Let's give you an example. The pain that you will feel when you lose, let's say, 100,000 pesos, that pain is actually much more profound than the joy that you'll experience if you earn or profit 200,000 pesos. So it's almost asymmetrical. So that is one of the reasons why in market environments like the one that we're experiencing today, investors tend to become risk averse because of this behavioral bias of being loss averse, investors tend to not take action, not invest, and many a times, uncertainty like the one that we are going through, like the one we went through exactly 2 years back when the first lockdown took place during the initial days of pandemic, those uncertainties might be rewarding for the clients over the long term. So remember, this loss aversion is the one that many of us experience today, and it does lead to inaction and inability for investors to take adequate position in their portfolios. But this slide, and I apologize, it's a busy one. I'm going to try and explain this to you. This is the US markets, S&P 500, the bellwether index in the US. And we've shown you the last 42 years of data of S&P 500. So the gray bars show you the calendar year return of S&P 500 every year. The red dots show you the intra-year worst correction or the worst decline within that year. So for instance, if you were to look at the extreme right-hand side, you see year till date, markets are down 5%. This is slightly dated. But at its deepest point, the markets had corrected by 13%. As you walk through from right to left, you'll realize that there are actually those red dots for every single year. Look at 2020. US markets gave up 1/3 of its value. It was down 34% during 2020, exactly 2 years back during the pandemic, whereas it recovered and closed the year 16% positive. Remember my quote just a moment back, uncertainty can be more rewarding. And similarly, if you go back to that, one of the deepest drawdowns almost 13 years back during the global financial crisis, which is about 2008, you see the intra-year correction was almost 50% in the US, and the market closed 38% down for the calendar year. But the next year, there was 23% returns, there's 13% returns, and so on. So one message that I want you to take away is there are three certainties in life: death, taxes, and volatility. If you're an investor, you just can't wish away volatility. And the answer is not to stay in cash, because cash over a long period of time is the least performing asset class, and several times is not even able to beat inflation. And therefore, you might think your money is safe, but inflation actually depreciates the value of your holdings. Let's stay with that point of uncertainty can be more rewarding. I'm not trying to say that it doesn't feel painful. Right now, if your portfolio is down, it feels painful. If you were invested in 2020, 2 years back, I want you to go back in your mind to that period of March of 2020 and remember how you felt. I'm willing to bet that 9 out of 10 of you felt more miserable than you feel today because, well, it's a once in a generation event. We didn't have a vaccine at that point in time. In Singapore, I can tell you, I was in the middle of what was called a circuit breaker. Philippines was also getting into a lockdown. So basically, the world as we knew had ceased to exist for a period of time. We were all wondering if economies are going to survive, if companies are going to be able to withstand these kind of shocks. And honestly, many of us, if we're employed with companies, we're wondering if our jobs are going to be safe. If you would have taken benefit of the uncertainty at that point in time, 2 years later today, you would probably be looking over your shoulder to say, you know what, even though I was feeling terrible at that point in time, the investment decision that I made actually led to gratification in my portfolio. And let me give you some evidence in a related context. So this is the China market, and I bring it up because Chinese markets have faced a brunt of correction as well as fall over the last now almost 15 to 16 months. So the gray bar that you see on the extreme right-hand side is the current correction, which started in February of 21. So it's down about 40% till we did this analysis in January 22. It's still somewhere around that. So an investor who's either thinking about investing or invested, it's quite painful. But what we've also done is, for your context, put the previous corrections right next to it. Remember what I said, one of the certainties of life is volatility. So just like that, Even in China, volatility has taken place in the past too. So whether it was 2018, when the markets fell 33%, 2015, when it fell 42%, or 2011, more than 10 years back, when the markets fell 37%, each one of those periods would have been quite terrible for investors. But if investors would have taken benefit of that uncertainty, I want you to focus on the green bars for each one of these periods. 32%, 27%, 25%. That's the return of just the Chinese markets in the 6 months subsequent to that correction. Again, building into that point of uncertainty can be rewarding, whereas remember what I said, risk aversion happens due to this emotional bias, behavioral bias that we experience because loss aversion. Remember, the pain of losing money is a lot more profound, which is why we make these mistakes in our investment portfolios. In that context, let's look at the biggest elephant in the room right now, which is Russia, Ukraine. You can't get through a conversation like this without talking about the biggest geopolitical event taking place in the past several years. But let me remind you, these geopolitical events have taken place at different points in time of the last 4 to 5 decades. So what we've done on this chart is to show you when was some of the previous geopolitical events. So whether it was the Yom Kippur War in the early 70s, whether it's the Soviet invasion of Afghanistan in the late 70s, there are plenty of them. And as I mentioned, the first response is risk aversion, and which is why you see markets within 1 week, 1 month, or perhaps even 3 months being in the red. But as you start stretching your horizon to a longer term and start moving towards the right of the screen, 6 months or 12 months, you start seeing a lot more green, which means a lot more positive returns on the screen. Again, building into that point that uncertainty in the long term can be rewarding. And that's what I want you to take away. So remember, the first behavioral bias that we spoke about was loss aversion, leading to risk aversion. Staying in cash is not the solution because it is an underperforming asset class. Now, the other thing that we do is spend a lot of time to try and guess the market levels. And this is quite a common behavioral bias because many investors feel that if they follow Bloomberg, Financial Times, Reuters, CNBC, they'll get a lot of information, and that information will equip them to make the right investment decision about where the market bottom is, where the top is, and allow them to take the right decisions. But the next few slides will show you that that's not necessarily true. So overconfidence is one of those behavioral biases which leads to underperformance of client portfolios relative to the markets. I often say in Asia, most of us are very good savers. So we save a substantial part of our annual income, but we are not necessarily very good investors. And there's a difference. You may save money, but you don't necessarily put that money to work in the right investments. And a lot of that is because of these behavioral biases. And one of them is overconfidence. So what do we feel about overconfidence in the daily life as well? Generally speaking, we tend to be overconfident about our abilities, not just in timing the markets. We also tend to overestimate our ability to, in a day-to-day life, to be good drivers. 93% of us think we are better drivers than we are. And gentlemen, 84% of us think that we are better partners than we actually are. And actually, the truth is somewhere around 50%. So we're all mortals. We tend to get biased and have a little bit more confidence in our abilities than what ought to be. But we are flawed. What about the mortals? What about the immortals? So let's speak about some of them. So for instance, Albert Einstein, one of the most revered scientists of the 20th century. He quoted in 1932 that there is not the slightest indication that nuclear energy will ever be obtainable. It would mean that the atom would have to be shattered at will. He said this just 13 years before the first atomic bomb. And of course, we know that after that, there was cleaner use of nuclear energy in the form of nuclear power. It's not just Albert Einstein. Thomas Watson, chairman of International Business Machines, the pioneers of the modern computer, in 1943 said, "I think there is a world for maybe 5 computers." I don't know about you, but I just told you that I'm at home, right in front of me, including my devices like the phone or the iPad. I have 5 computers in front of me. So he got it awfully wrong. Unrelated, in the music industry, we all know how popular Beatles became, but Decca Recording Company in 1962 said, no, we don't like the music, and anyway, guitar music is out of the way, on its way out. I'm just giving you examples of subject matter experts in their field, whether it's a scientist, whether it's a computer engineer or a recording company, just getting it terribly wrong, despite being professionals in their industry. So, like I said, you and I are mere mortals. It's fine if we make some of these mistakes, but it's important to acknowledge that the overconfidence that we feel because of the information that we get does lead to wrong investment decisions. So let me take another example, and maybe some of you are familiar with horse racing. In horse racing, you have handicappers. Again, a research was done where these handicappers were provided a certain amount of information. So on this chart, on the horizontal axis or the x-axis, you find from left to right, the number of items of information being provided to handicappers increasing. The blue line is showing you the confidence of those handicappers in their ability, after looking at that piece of information, in their ability to predict the right winner. But the gray bar shows you the accuracy of handicappers. You notice as we go from left to right, which means that more information is being provided to handicappers, clearly the blue line goes up, which shows you that because more information is coming to them, their confidence level is going up. But check out what's happening to the gray line, which is accuracy, or their ability to predict the right winner. Actually, after 20 items of information, accuracy actually falls. So it's not just in the field of investments, this desire to time the markets. We face this even in investments, where reading more financial news very often breeds confidence in many of us, which leads to wrong investment decisions too. I'm gonna support this with more evidence as I walk through it, but let's just pivot towards one of the most commonly felt behavioral bias, which is herding, literally following the herd. But before I come to an example in the financial markets, let's address this very, very common behavioral bias in our day-to-day lives. Now, here's the good news. I'm sure you're all looking forward to borders reopening. They are indeed reopening. Singapore's borders are relaxed to a large extent. Europe is open. US is open. Now, if you are planning a summer break or a holiday with your family anytime soon, I'm pretty sure after 2 years now that you're getting this opportunity, you're going to do a lot of research. You're going to go to Lonely Planet. You'll probably go to TripAdvisor. And while you're in, let's say, Europe, you're going to identify some of the best places to go and dine at. So say you've decided which restaurant you want to go to, and you reach there sharp at 12 noon for your lunch, and the restaurant looks like this, empty. Now, remember what I said. You've done plenty of research through Lonely Planet, through TripAdvisor, multiple sources. But while standing there, you're wondering, what's this? Why is this empty? And you look across the street, and the other restaurant looks like this. But in your research, this restaurant didn't pop up. What are you going to do? I can tell you 8 out of 10 of us will forget our research, which is the top left-hand side. We're going to go with the herd, which is the bottom right-hand side. We find safety in numbers. We find it reassuring that if more people are going there, they're probably making the right decision, which is not the case many a times. And that's what several of us are facing when it comes to cryptocurrencies today. Because many of us see our friends, relatives, colleagues dabble in cryptocurrencies and make money, there is this sense of following the herd, which again, may not be the best investment decision. Now, I mentioned this is in daily life. What happens to financial professionals? It actually happens to financial professionals as well. So say, let's think about an analyst, a financial analyst that covers a company like Apple. They come up with these quarterly estimates of profits. And let's say for this quarter, most of the analysts from various investment banks predict the earnings for Apple to be between $100 to $105. Now, this is a completely hypothetical example just to illustrate. So please don't think this is accurate. It's more meant to be an illustration. So majority, almost 99% of analysts predict the next set of profits for Apple to be between 100 and 105. But here is an analyst who follows technology a lot closer and discovers through his knowledge about technology that the next revolution of releases that Apple will do will actually be a lot more profitable. And therefore, he thinks that the next profit release should be $120, not $100 to $105. But this 120 is way off the mark. And he's actually the only one predicting at 120. If he gets it right, he's a star because he's the only one. But if he gets it wrong, the reality is he will be the only one potentially losing his bonus, losing potentially his job also, because the rest of the field was at 100 to 105. He was completely out of whack at 120. So in order to find comfort and safety in numbers, he predicts instead of 120, which is high conviction, he actually predicts it at 108, which is a lot closer to the herd. Why does he do that? Because he's able to find peace with the fact that even if he gets it wrong, he's not wrong by a huge margin. And if it indeed comes out to be 120, at least he was the only analyst which predicted 108, whereas 99% of the others actually predicted between 100 and 105, which is why many a times when analysts do predict, 7 out of 10 times, there is a profit beat by companies because of this herd mentality that even professionals feel. So let's just very quickly go to the final one, which is anchoring. Less relevant today, but I assure you, just like Jerome mentioned that dark and overcast skies will give way to sunny times, I assure you we'll get to sunny times at some point. And this is a behavioral bias that you will experience. But again, what does anchoring mean? Let me give you an example. Say my wife and I better be careful because I'm at home. My wife and I go into a shopping mall and she walks into a store of bags. The first one, and let's say this is BGC in Philippines, and the shop attendant says, the first bag that she looks at, he says it's worth, let's say, 10,000 pesos. At this point, I'm like, yeah, that's fine. Okay, let's think about it. She looks at another bag, and all of a sudden, the price of that is 50,000, and I start sweating at this point because I'm now anchored to that 10,000, just because that was the first price that was quoted to me, because that's become my anchor. Anything next to that, I will start referencing it to it. The third bag that my wife looks at is, let's say, 100,000. At this point, I'm just having a panic attack and I'm trying to beg my wife to come out of this because I started with 10,000. And that, in the context of the market, happens when the market starts hitting all-time highs. You must have heard this. US markets hitting all-time highs. Philippine markets hitting all-time highs. The first mistake we make is we get anchored to that number, and we often think that number means that the market is too expensive. And therefore, either I will not invest, or even if I'm invested, I might even make a decision to redeem my investments and exit because I think markets are at all-time high. Oh, they got to be very expensive. But what we're showing you here on this slide is that if you were, and let's look at 2013, these bars are showing you how many new highs are made in some of these calendar years. If in 2013, during the first few all-time highs, if any one of us would have made the decision that the market is at all-time high, we need to exit or not invest, you would have missed out 45 other new highs, 53 in the next year, and so on, several hundred new highs. And look at that green bar, which went from almost 1,500 S&P level to almost 4,500 level. So you would have missed out the big upside. So anchoring is another bias. The other reality, and this is a very interesting study. So this is since 1998 till present, so long history. And the data was essentially to analyze what kind of returns do you make if you invest for 1 year, 3 years, 5 years. If you were to invest any given day of the markets, and that's given in the gray bars, invest any day, what is your average return? Now, remember, this is average. It doesn't mean every single year is going to be positive. But 1 year, 3 year, 5 year would have been 12, 40, and 72% cumulative returns if you would have invested any day, average returns. Now, counterintuitively, unlike the bias that we have, if you were to invest at a new high, actually the returns turn out to be better. So 1 year compared to 12.2, 15%, compared to 40% if investing on any day over 3 years, it's actually 50%, and almost 80% over a 5-year period. So evidence suggests that investing while markets are hitting new highs tends to give better experience than investing any given day. You could explain that by saying markets tend to hit more new highs when there is fundamentally strong characteristics in the market. There is bullishness, the economies are doing well, companies are showing more profits, and therefore they continue to hit new highs. Now, I know it's a moot point speaking about some of these speculative manias, but let me just show you that it's not just in today's era that investor biases or behavioral biases have led to mistakes at a massive mass scale. There have been speculative manias in the past because of several of these behavioral biases, namely because of overconfidence, herding, etc., which has led to speculative manias or bubbles, as we call them. For instance, in the 17th century, one of the earliest speculative bubbles on record, one of the tulip bulbs sold for a price which you could have used to buy one of the grandest homes next to the canals in Amsterdam. Let's come more towards the recent history, the early 2000s or late 90s, the dot-com boom followed by a dot-com bust. In that period, just in a period of 6 months, NASDAQ actually went up 85% just in a matter of six months. And its price earnings multiple, for those of you who follow that, it's a standard measure of valuations, went to 190 times, which is, by any stretch of imagination, extremely demanding. There were 457 initial public offers in 1999, out of which 117 doubled on the day of its listing. By the way, some of those didn't even last for a year. Some of these companies didn't even last for a year after that. So that was one of the most recent bubbles in public markets or stock markets. I was interested to read there was a Chinese walnut mania in the early 2010s, which is when it became a status symbol to own bigger, older, and more symmetrical. And actually one pair was listed at 31,000 US dollars. And more recently, I apologize to all of you who are crypto bulls. We are quite cynical about the frenzy towards cryptocurrency. Potentially, this is one of the next speculative mania being formed as we go through it. So hopefully I've walked you through some of these behavioral biases and they've resonated with you. But the next question which comes very often is, what do you do in order to address some of these? Now, I acknowledged and gave you disclosure right at the outset. I also suffer from them. I'm also mortal. But some of the tools that you could use is, for instance, this slide. The reason I bring this up is because it's important for us to have the right investment horizon. The longer your investment horizon, the better the likelihood of a positive outcome. Let's walk from top to the bottom. Now, this is again, US markets, S&P 500. If you're a 1-year investor with a horizon of just holding your investments for 1 year and you're investing into S&P 500, you would realize that majority of the period of since 98 till 2022 in green, which shows you its positive outcome. But there are periods like that 2001 till 2003, where you see gray, which is showing you that's the period where if you're a 1-year investor, you've probably experienced negative returns. And similarly, in 2008 till 2009, there would have been periods of negative returns. But the good news is, majority of the period, there's still positive returns. What happens when you, instead of having a 1-year horizon, have a 5-year horizon? You will notice that the frequency and the width of the gray bars has actually narrowed and reduced significantly, which shows you that the outcome is a lot more favorable when your horizon is 5 years compared to 1 year. What happens when you stretch your investment horizon to 10 years? There's only one brief period in the late 2000s or close to about 2008, 2009. Other than that, it's positive returns all throughout. So longer the time horizon, the better it is. It's not the market timing that matters. It's the time that you spend in the market that leads to success. The other thing which is very important, despite me showing you some evidence towards equities performance over the long term, it's important not to bet your house on just one asset class. Stay diversified. And the reason I say that is because everybody's risk tolerance is different. Everybody's financial objectives are different. Somebody may be looking to retire in the next 5 years, or 10 years, or 20 years. Somebody may have a financial goal coming up in the next 3 to 4 years. Therefore, the tolerance of risk should also determine the asset allocation in your portfolio or diversification across different asset classes. So again, on this slide, what we're showing you since the last 20 years, data since 2002, we're showing you performance in the green bars of each one of these asset classes. So asset allocation, which is the one on the extreme left, is a diversified portfolio. It holds stocks, it holds bonds, it holds US as well as global stocks, and so similarly on the bond side. And S&P 500, you would have figured out by now, is the main benchmark in the US. Emerging market benchmark is given in the third green column or green bar. Russell 2000 represents a broader US market universe, including some small and mid caps also. Now, one thing I want you to take away is that each one of these markets has delivered quite handsome returns. So the mid and small cap or Russell 2000s delivered 9.5%. Emerging markets delivered almost 10%. S&P 500s delivered 9.5%. And these are annualized returns compounded over that period of time. And asset allocation, which is diversified portfolio, is actually not a whole lot away from even an emerging market portfolio. But now I want you to bring your attention to what I think is the most important aspect, which is risk. And that's shown in the dark gray bars. So while emerging markets have delivered almost 10% returns, it's come with significantly higher volatility that we in the financial world use as a term to represent risk. If you notice the risk that you take in, let's say, emerging markets, Russell 2000, which is in the 20s, compare that to an asset allocation, which is a diversified portfolio, which is less than half at 10.5%. As a result, here comes the hero of this slide, which is the blue diamonds. It's mentioned as Sharpe ratio. Please don't worry about the technicality. Just remember that this ratio shows you the efficiency of your portfolio. So how much return do you make for every unit of risk? Or very simply put, the higher the number, the more efficient your portfolio is because you're taking the least amount of risk for the returns that you're generating. You notice, so while S&P 500 showing 0.51, emerging markets showing 0.38, the blue diamond for asset allocation is actually significantly higher at 0.65. So sure, the returns are slightly lower than equities, but a diversified portfolio is a lot more tolerant to people who can't take just a pure equity risk like 20%, 21% volatility that you see from some of these markets. So I've spoken to you about your stretching your horizon for the long term. I've spoken to you about staying diversified and therefore being able to control risk in your portfolios. Finally, I'll come to the point that I made on overconfidence, which is this desire and confidence that we have in our abilities to time the markets. What we're showing you here, again, I apologize, this is S&P 500, largely because it has the most, it has the biggest data set and the longest history, which is why we can show this to you. Again, since the last 20 years, since 2001. Now, on the extreme left-hand side, we're showing you somebody who invested, let's say, $10,000 in 2001 and just stayed invested for the next 20 years. Didn't do anything at all. Didn't come out, didn't try to time the markets. That $10,000 became $42,231, a compounded return of almost 7.5% in US dollar terms. Now, the rest of those bar graphs are for, let's call them investors like me, who tried to time the market. And while I was trying to time the markets over the last 20 years, I missed the 10 best days of the markets because I couldn't predict those. My return actually fell significantly to 3.35. What if I would have missed 20 best days because of market timing or my desire for market timing, my investment would have probably been flat at less than 1%. If I would have missed out 30 best days, I actually would have lost money in that period of time. What you see in the blue box in the center of the slide is that 7 of the best 10 days occurred within 2 weeks of the 10 worst days. What it's telling you is the best days of the markets very often are followed after the worst days of the market. 6 of the 7 best days of the markets occurred right after the worst days. And even in 2020, which is etched in our memory, because that was the pandemic, March 12th was the second worst day of 2020, which was immediately followed by the second best day of the year. Again, if any of us would have tried to time the markets or would have felt risk averse, loss averse, and not taken decisions and stayed out of the markets, we would have missed one of the best days in the market. So hopefully some of these behavioral biases, which now brought to the surface, do resonate with you. And whether it's diversification, stretching your time horizon, or instead of trying to time the markets, spending more time in the markets, these are some of the tools which perhaps you could utilize through as tools to overcome some of these biases. You can't make it zero, but I would say that if you can use some of these tools and some of these insights and build that into your decision making, I think that'd be success from this seminar as well. And even in today's context, it is a very, very emotional time. There's so many, if you pick up any news report or go to a news website, you'll read about geopolitics, you'll read about inflation in the US, you'll read about interest rate hikes, quantitative tightening, clearly very, very emotional times. So, we felt much better 1 year back. We're feeling a lot less better right now. But just like I asked you to go back in time in 2020, some of these periods are often short-lived, and over the long term, a long-term investor is rewarded for the right decisions. I'm going to pass it back to Jerome, and I look forward to your questions. Thank you very much for listening in patiently.
Wow, great talk, Supreet. Personally, being around the industry for also a decade, handling financial advisors, selling investment solutions directly to clients. I'm a big believer that handling behavioral biases is equally important as the market performance of our investment. So great topic, great talk, obviously. But before we go to the Q&A, I'd just like to give some announcement relating to Atram. So Atram has a wide range of investment products, and our capabilities span across several asset classes, meant to service the different investment objectives of our clients, of each individuals. And with this, it is with great pride that we announce that Atram has recently won the Best Investment Solution Provider in the Philippines for 2022 from the International Business Magazine Award and World Business Outlook Awards. So for today's session, we do hope that somehow this has assisted you to #take on tomorrow by investing your hard-earned money with an award-winning fund house as Atram. So at this point, we would like to move on, Supreet, to the live questions from the audience. So we actually have several questions coming in, but being the host, I have the privilege to ask my own questions first. So Supreet, are you ready?
Go easy on me, Jerome.
Yeah. So actually for me, the first question is, are professional investment managers better at dealing with behavioral biases than everyone else?
That's actually a good question. I would say they're not immune to behavioral biases, but they do have some tools and mechanisms which are at play to minimize or mitigate some of these behavioral biases. For instance, in large organizations such as JP Morgan Asset Management, a portfolio manager cannot operate unilaterally. That portfolio manager is governed by investment directors or sort of an investment committee where the portfolio manager is meant to present his ideas, his objectives, and so on. And it's challenged, it's also debated, and therefore diversity of thought in that group leads to mitigation of some of these behavioral biases of the portfolio manager. But there are also some of these constraints that are put in portfolio management, Jerome, that we are very familiar with. So for instance, you can't have beyond a point certain stock concentration in your portfolio. You can't have industry concentration beyond a certain point. You can't have geographical. So these are some of the constraints that are put in place to mitigate, not have zero, but mitigate some of these behavioral biases. And finally, one of the things which regulators have ensured is to have an investment mandate for each one of the unit trusts or mutual fund. Despite all the behavioral biases, no matter how a portfolio manager feels about a certain market or a stock or a security, the constraints put by the regulator, which is you cannot overstep your investment mandate, is one of the ways to check and control some of these behavioral biases. So remember, it's not zero, but it's a lot lesser because they operate under governance. And finally, there is this big layer of risk management that sits in these large organizations. The benefit of risk management is lesser profound during bull markets, but they emerge as a very important protector of client assets during markets like these, because that's when the value of risk management comes through. So I would say a combination of these does lead to mitigating, reducing behavioral biases. It still does not neutralize it to zero.
Great answer, Supreet. Actually, last night the article that I was reading, it's about the work of Harry Markowitz. Essentially, he said the modern portfolio theory that he pioneered essentially gave portfolio management a process, and that those processes are essentially trying to mitigate behavioral biases even for professionals, professional investment managers. So spot on answers. So let me go to a question that is more relevant today. I mean, the markets today. How do some of these behavioral biases you have discussed observable in the markets today?
The first one I highlighted, which is risk aversion or loss aversion. Because portfolios are down, markets are falling 2-3%, clients tend to become extremely loss averse, which leads to risk aversion in the portfolio. So say if your portfolio deserves an asset allocation, which has been recommended by our advisor, that you need to have a balanced portfolio of 50 stocks and 50 bonds. In today's context, several investors are choosing to not invest into equities and therefore are underexposed to risk assets. And owning risk actually works over a period of time. As I said, not owning risk means you're sitting in cash, is highly inefficient because inflation eats away at that cash. So the biggest mistake that's taking place in today's context is risk aversion, and also overconfidence in some manners, because people are spending too much time on the news. And remember, Jerome, the news channels have a different objective than you and me. We are saving for our retirement. We're saving for our long-term financial objectives. Guess what? And with all due respect to journalists, what do they want to do? They want to get eyeballs today. So they have to write something sensational, which will get your eyeballs towards those articles. But clearly, whether it's a portfolio manager which is managing a portfolio for 3 years, 5 years, or all of us who are managing our portfolios, our personal investments for the long term, our objectives are different. So too much of focus on information, very little on your objectives over a period of time, and also loss aversion leading to risk aversion right now.
Yeah, and if I may add, anchoring is also very relevant, especially to investors who have invested in securities pre-pandemic. So let's say the price is 100 USD. Of course, the COVID-19 changed the game, changed the intrinsic value of the securities, but they still hang on to that, whether that's losing money or making money. So I guess to your point, at a certain degree, all of these behavioral biases are still present, ever present in today's market. And to connect to that question, Let me also ask something about the current crisis in Russia and Ukraine. So the Russian-Ukraine conflict has reached a point where it seems there will be no longer any major developments, i.e., all the economic sanctions have been charged to Russia, have already been lifted. Russia scaled back the size of its armed forces, etc., etc. However, a lot of investors remain hesitant to book or add risk assets into their portfolio. So I guess could you give some insights as to why that may be? Obviously, you have alluded to that earlier, but maybe can you give us a recommendation on ways we can convince them now that it's an opportune time to invest or not to be too risk averse given the situation?
Well, I think it's a great point and worth covering again. In my presentation, I used one of the slides which highlighted the previous geopolitical episodes, the ones in the 70s, whether it was the Yom Kippur War or the invasion of Afghanistan. That could be one of the ways to look at the markets, which is sure, it's natural. Listen, as human beings, we are hardwired to respond negatively to situations of threat and risk. It's centuries of evolution, right? So if you see a predator, your brain's hardwired to tell you to go run for safety. Similarly, when you see risk in your portfolios, your first response is to not add or invest into the markets. So I would say all that you're reading about Russia, Ukraine, frankly, none of us, at least Jerome, I'm not an expert on geopolitics. I don't know what the outcome is going to be. But I focus on the long-term fundamentals of companies. Now, if the prices have fallen a lot more than the fundamentals of those companies, that's the near-term opportunity that comes up. This is called a dislocation. When prices dislocate from the fundamentals of the companies, profits may fall by 5% because of geopolitics, but the stock price may have fallen 20, 30%. That's a dislocation. That's an asymmetric outcome. That leads to an opportunity in the near term. Now, I'm not going to make light of the fact that while you're living through it, it feels absolutely terrible. And it needs a lot of character on the part of an investor to make positive investment decisions right now. Because remember, it's loss aversion, but also herding, because nobody else is investing at this point in time. Which is why I often keep quoting, and I apologize, I'm saying this again. Warren Buffett says, when others are fearful, be greedy. When others are greedy, be fearful. So I wish there was a simpler way. There is none. There is no one standard rule of thumb that people can follow. It's really a lot about focusing on fundamentals, focusing on long-term, and focusing on diversification also. Very simply put, as I mentioned, in my person, and I'll speak about it as an investor, if I don't know the outcome of the Russia war, the solution for me is to diversify. So, that is exactly what, investors probably should evaluate as well. If you don't know the outcome of a geopolitical issue, don't bet your house on any one single asset class, diversify.
Again, great answer to that difficult question. I mean, if you ask, probably investment journalists, they'll have different answer. But if you ask someone who's been in the field, really investing clients' money, you also get a different answer. And diversification it proves that diversification works not just in good times, but also in market volatility or heightened volatility times. So let me ask a different question. I think this is kind of related as well. What do you think will be the best asset class to invest this year? Maybe from a tactical allocation perspective, because we all know that the strategic asset allocation should be set in place, whether good times or bad times. But for tactical allocation purposes, what do you think is the best asset class for this year?
Very difficult to answer. 1 year, very short term in nature, so many variables. I almost wish I had a crystal ball which I could gaze into and tell you the answer to that. Again, I don't know what's going to happen after 1 year. Why is just the view just 1 year? Are you retiring in a year's time? If you are, then I assure you, your investment should not be in a risk asset class. It should be in a very conservative portfolio. But if your horizon is longer, how does it matter what happens in the next 6 months? Again, I go back to the comment that I made earlier. The amount of time we spend on trying to time the market, which is the best asset class. Well, if I knew it, I'd probably sitting on an island of my own, sipping a nice pina colada, I have to admit. I just don't. And I have to admit, many people who claim, who know, well, it's their view. It may come true, it may not come true. So our view is between equities and bonds. Equities look a little bit more attractive, but it doesn't mean that you should go and allocate more than your strategic asset allocation in equities. Each asset class has a role to play. So if you're a captain of your ship, let's assume the ship being your portfolio and the dock being your destination or your investment objective, your financial goal. You as a captain, you know that you have two tools at disposal. One is your propeller, that's your equity. That's going to take you towards your goal. But what happens when there's a storm? You need an anchor. You drop anchor and you hope like hell that your ship survives, and that's fixed income. So you can't go towards your goal with just one asset class, because if you just have an anchor, you're not going to move. If you just have a propeller, well, during stormy times like the ones that we're in, you will face a lot of choppy weather at that point in time. So I would concede that I don't have a very, very high conviction on saying what's going to be the best asset class in the next 1 year. However, if you have to take a view, JP Morgan's view is that equities will tend to do better than fixed income over the next 1 year.
Yeah, but let me answer it differently as well, Supreet. My answer is you invest in the global multi-asset income feeder fund of JP Morgan. I mean, it's already well diversified. I mean, all the difficult decisions have already been taken care of from the client's perspective. I guess the only thing that the client will have to do is control his emotion, when to buy, that time the market, just keep investing in that fund, right? So, good. Okay, so I guess I have one last question, Supreet. And again, it circles back to my own personal question relating to this matter. Are all behavioral biases bad?
Well, that's a profound question. Let me just say, listen, we're all human beings, right? Like I said, we're hardwired in a certain way because of centuries of evolution. We can't wish them away. So behavioral biases aren't bad, but if they lead to investment decisions entirely dominated by those behavioral biases, that could lead to investment mistakes over the long term. So I'm not here to judge behavioral biases because I suffer from them myself, Jerome. But I do make an attempt to try and mitigate and reduce the influence of those behavioral biases in investing. So what you need to focus on is, listen, we are all human beings. We're going to feel this every time. If your best friend's going to make a huge amount of money in cryptocurrencies, you are going to get tempted because you are human after all. But you need to focus back into what is your objective, what is your financial goal, how much of risk tolerance do you have? If you're going to invest in crypto, please be prepared to lose all your capital potentially. Not something that happens in public markets, but in a sense, you need to be calibrated and really work with your financial advisor to come to the most appropriate asset allocation that you can have, and navigate the times in the future by adjusting those asset allocations. I'm not trying to downplay the importance of information, but from that information, separate the noise from the signal. There's a lot of noise in the markets today, but the true signals are insights that you can draw from them. So hopefully, through the course of this presentation, you've been able to understand some of these biases And as long as you can acknowledge some of these biases the next time you're faced with them or about to take an investment decision, again, remember, they're not bad, but the decisions that you make, if you're heavily influenced, that might not be the best investment decision. So we are going to experience it. Just try and see if you can neutralize that and mitigate that by working with your advisors.
Great point, Supreet. Actually, you mentioned earlier about the father of behavioral finance. Maybe one of them is Daniel Kahneman. I had the privilege back in 2017 to attend one of the conference, and that similar question was asked: Are all behavioral biases bad? And I think he made a good point that behavior biases are there. I mean, like you said, all of us are humans, investors are humans, it's going to be there. But being aware of it, you can actually benefit from it, right? If you see the market doing herding mentality, you can see, oh, it's a behavioral bias, and I could use that to my advantage. And again, to your point about speaking to your financial advisors, we are fortunate enough that in these ATRAM webinars, about 20 to 25% are actually financial advisors. So speaking to the financial advisors that are in attendance, a lot of times financial advisors focus on finding the best funds for their clients. Rightly so. I mean, that's basic. But I guess in today's time, we also have to be a behavioral coach to our clients. We don't only focus on the looking for the best funds that are performing or setting even the right asset allocation, but we also have to guide our clients in terms of their behavior. So great talking to you, great webinar today, Supreet. But unfortunately, that is the only time that we have for these questions. So before we wrap up, any last words, Supreet?
Yeah, Jerome, thank you for articulating it so well. I will just say, since I started by quoting one of the revered investors, let me also close by quoting another revered investor, and this time it's John Templeton. John Templeton actually said, bull markets are born in extreme pessimism. They grow in skepticism. They mature in optimism and die in euphoria. I think that sums up a big chunk of the behavioral biases that we spoke about today. Thank you so much once again for the opportunity to speak to you all, and Jerome for inviting me. Thank you to ATR Asset Management. Absolutely, it was my honor and a privilege to do this. I'll pass it back to you, Jerome.
Yeah. Once again, thank you, Supreet. And of course, to all of our audience, I mean, it's past 12. I know you are planning for your lunch, and we appreciate you taking the time to join us today. We hope you were able to gain insights and key takeaways from today's webinar. Now, did you know that for as low as 1,000 pesos, you can already jumpstart your investment journey? Here's how you can invest in ATRAM funds.
Hello. To open an account with ATRAM, just visit our website at www.atram.com.ph. Here, you can learn more about all the funds and services that we offer. Our site will then guide you to our online investment platform, Seedbox, where you can start investing for just 1,000 pesos. But if you have more questions, visit the website's Frequently Asked Questions page or ATRAM Academy page. Thank you.
So again, join us on our next live stream, Financial Adulting. Things I wish I knew when I got my first paycheck. Wow. How I wish I could go back 15 years ago. With Coach Yanni Moya on April 21. So join the live stream event by scanning the QR code, or you may also visit our Facebook page and YouTube channel. Again, if you have any friends who you think would like this webinar but are unable to attend, please feel free to share the YouTube replay of the session once it is uploaded. Visit our YouTube channel, ATRAM Studio, scan the QR code, or visit our official social media pages. We would like also to invite you to join our ATRAM's official Viber community group, #ATRAM PH community, to stay updated on the latest announcements, advisories, and reminders. Scan the QR code or visit the link found on your screen and get a chance to win ATRAM merchandise. Lastly, please answer the survey at the end of this webinar. We really want to improve. We would love to hear your thoughts on today's topic. On behalf of everyone at ATRAM, thank you again for your attendance and participation. We wish you and your loved ones continued health and safety. Have a great week. Have a great Holy Week next week. Thank you.